A seismic shift is brewing in the global coffee industry. Keurig Dr Pepper has launched an $18 billion all-cash takeover bid for JDE Peet's, one of Europe's largest coffee and tea specialists. This isn't just another merger, it's a bold move to challenge Nestlé's dominance and reshape the coffee landscape from North America to Europe. By combining Keurig's single-serve coffee strength with JDE Peet's iconic European brands, the new entity would command an unmatched global presence. For consumers, this could mean new brands on shelves, price changes, and a wave of innovation in coffee products. As we dive into the details, one thing is clear. Keurig Dr Pepper is redrawing the global coffee map. To truly grasp the significance of this merger, let's take a closer look at the two industry giants at the heart of this transformative deal. Their combined influence is set to reshape the global beverage landscape in ways we've never seen before. Keurig Dr Pepper, often called KDP, is a household name in North America. The company revolutionized the way Americans brew coffee at home and in the office with its innovative single-serve brewers and convenient K-Cup pods. But KDP is more than just coffee. It's also the force behind iconic soft drink brands like Dr Pepper and Snapple, making it a major player in both the coffee and soft drink markets. With a strong presence in millions of homes and stores, KDP has become synonymous with beverage innovation and consumer choice. On the other side of the Atlantic, JDE Peet's stands as a global coffee powerhouse headquartered in the Netherlands. With a portfolio of over 50 brands, JDE Peet's reaches coffee lovers in more than 100 countries. Its brands, like Jacobs, Douwe Egberts, and Peet's Coffee, are staples in homes, offices, and cafes across Europe, Asia, and beyond. The company's deep roots in European coffee culture and its expanding global footprint make it a leader in the international coffee scene. KDP dominates the U.S. single-serve coffee market, setting trends in convenience and variety, while JDE Peet's leads in Europe and is rapidly growing in emerging markets. Together, they cover nearly every corner of the world's coffee map, from American kitchens to bustling European cafes. This merger brings together Keurig's cutting-edge brewing technology and K-Cup expertise with JDE Peet's rich brand heritage and international reach. The result is a beverage company with the scale, resources, and creativity to serve nearly every coffee occasion worldwide. Whether it's a quick cup at home, a specialty brew in a cafe, or a refreshing soft drink on the go. It's a union of American convenience and European tradition, blending innovation with heritage. Together, Keurig Dr Pepper and JDE Peet's are poised to change how the world drinks coffee, making every cup, everywhere, a little more connected. Let's talk numbers. When it comes to major corporate deals, the figures tell a story of ambition, strategy, and market confidence. Keurig Dr Pepper's headline offer stands at $31.85 for every JDE Peet's share, which adds up to a staggering $18 billion. This isn't just a routine buyout. This is a bold move that puts KDP in the spotlight, signaling their intent to reshape the coffee industry landscape. The all-cash bid represents a significant premium over JDE Peet's previous trading price, crafted to win over even the most cautious shareholders. It's a clear message. KDP is serious about this acquisition and is willing to pay top dollar to make it happen. The roots of this deal stretch back to August 2025, when whispers of a potential acquisition first hit the market. Almost overnight, JDE Peet's shares soared by 17% as investors rushed to get in ahead of the news. Now, with the formal offer on the table, the market remains optimistic. JDE Peet's shares are trading just above the offer price, a sign that investors believe in the deal's potential and perhaps even anticipate a bidding war or a sweetened offer. Both companies expect to finalize the transaction by the second quarter of 2026. If all goes as planned, this will rank among the largest consumer goods deals in recent memory, reshaping the competitive landscape for years to come. KDP's offer closely matches JDE Peet's current market value, underlining just how serious and calculated this transformative bet on the future of coffee truly is. The financial world is watching and cheering this high-stakes move, as analysts and investors alike speculate on what this could mean for the global coffee market and beyond. Unlike many mega mergers, this takeover has overwhelming support from within JDE Peet's. The board of directors unanimously recommends shareholders accept KDP's offer, signaling strong belief in the merger's benefits. Major shareholders holding 69% of JDE Peet's have already made irrevocable commitments to sell, virtually guaranteeing the deal's success. This level of backing eliminates uncertainty and blocks potential rival bids. With the board and a supermajority of shareholders on board, KDP can move forward with confidence. The focus now shifts to seamless integration and executing the vision for a global beverage powerhouse. This united front demonstrates a shared belief in the strategic and financial upside of the merger. The real twist? After the merger, Keurig Dr Pepper plans to split into two separate, publicly traded companies. One will be a pure-play global coffee giant, uniting the coffee assets of both KDP and JDE Peet's. The other will focus on soft drinks and juices, including Dr Pepper, Snapple, and Canada Dry. This strategic split allows each business to focus, innovate, and attract investors with different appetites, coffee growth, or soft drink stability. The new coffee company will challenge Nestlé globally, while the beverage company will double down on North American favorites. Specialization, not diversification, is the new strategy, unlocking value and sharpening each company's mission. It's a bold plan to create not one, but two stronger, more focused industry leaders. Funding an $18 billion deal takes careful planning. KDP secured $7 billion from private equity partners in October 2025, showing strong outside confidence in the merger. The rest will come from KDP's cash reserves and new debt, leveraging its strong financial position and access to favorable borrowing rates. Private equity's involvement shares the risk and signals belief in the post-merger strategy, especially the planned split. KDP has already cleared all regulatory hurdles, removing a major obstacle for mega mergers. With financing and approvals in place, the path is clear for this ambitious vision to become reality. The meticulous approach to funding and regulation highlights the deal's strategic discipline. This deal comes as the coffee industry faces major headwinds: soaring bean prices, climate-driven crop failures, and trade tensions. Droughts in Brazil and Vietnam have slashed yields, sending prices to record highs and squeezing margins for roasters worldwide. Trade tariffs and shifting policies add more uncertainty, making long-term planning tough for global players. By merging, KDP and JDE Peet's aim to use their combined scale to weather these storms, securing better contracts, optimizing supply chains, and absorbing shocks. The new giant's purchasing power could help stabilize costs and ensure a steady supply, even as volatility continues. In a turbulent market, size and diversification become powerful tools for survival. So, what does all this mean for your daily coffee ritual? Whether you're a casual sipper or a devoted aficionado, the effects of this merger could soon be felt in your morning routine. In the short term, prices could go either way. KDP-JDE's combined buying power might help keep costs down for consumers, at least initially. Or, on the flip side, reduced competition could eventually push prices up, especially if smaller competitors are squeezed out. Regulators have approved the deal after careful review, but that doesn't mean the story ends here. Consumer groups and watchdogs will be keeping a close eye on the new company, ready to sound the alarm if prices rise or if choices shrink. This scrutiny could help keep the company in check, at least for now. On the bright side, Keurig's innovative brewing technology combined with JDE Peet's vast array of brands could lead to exciting new products and flavors hitting the shelves. Imagine seeing more premium options, like L'Or K-Cups, becoming widely available in the US market, or perhaps Keurig brewers and pods making a bigger splash in European homes and cafes, changing how people enjoy their coffee across the continent. With cross-promotion and a truly global reach, you might find more variety and international blends at your local store than ever before. However, there's a real risk that smaller brands could struggle to compete for shelf space and attention, making it harder for unique or local coffees to survive. The merger could spark a wave of creativity and new ideas within the new coffee giant as teams collaborate and experiment with new concepts. But there's also the risk that the market becomes less diverse, with fewer brands and less choice for consumers if the big players dominate. Ultimately, the future of your morning cup will depend on how this new titan balances efficiency, innovation, and fair competition, shaping not just what's in your mug, but the entire coffee experience for years to come. This $18 billion deal is more than a merger. It's a fundamental shift in the coffee world. The new KDP-JDE entity will become a true rival to Nestlé, igniting fierce competition at the top of the industry. This rivalry could drive innovation, better products, and more sustainable practices, as both giants vie for consumer loyalty. The planned split into focused companies may inspire other conglomerates to follow suit, sparking a trend toward specialization. As of January 15, 2026, the global coffee landscape is on the brink of transformation. For competitors, it's a wake-up call. For investors, a new chapter. For coffee lovers, a promise of change. The world's morning brew is about to get a lot more interesting.